This is a dramatized story inspired by real debt situations. For educational and entertainment purposes only. Not legal or financial advice.
$81,000. That was the number staring back at me from a manila folder on my kitchen table at 2 a.m. I was 43 years old, and my restaurant, the one I'd poured 11 years of my life into, was gone. Not struggling, not barely hanging on. Gone. And I had no idea what I was supposed to do next. My name is Marcus. I grew up in Columbus, Ohio. My dad ran a diner for 30 years, and I watched him do it. Early mornings, late nights, flour on his apron, pride on his face. When I was 32, I opened my own place, a Southern comfort food restaurant, 12 tables, a wood-burning smoker out back. I called it Ember and Oak. For almost a decade, it worked. Not lavishly, but it worked. We had regulars. We had a wait on Friday nights. I employed 11 people. I coached my daughter's soccer team on Saturdays because I had just enough breathing room to do it. Then 2020 hit. Then 2021. Then the supply chain problems. Then inflation. By the time I was sitting at that kitchen table in early 2023, the debt breakdown looked like this. SBA small business loan, $34,000 still owed. Business line of credit, $18,500. Personal credit cards I'd used to cover payroll, $16,200. Equipment lease buyout, $7,300. Back sales tax to the state, $5,100. Total, $8,100. And my monthly revenue had dropped from $42,000 at peak to under $11,000, which barely covered food costs and rent, let alone payroll or debt service. I had already laid off 7 of my 11 employees. The 4 who stayed were people I'd known for years. One of them, Darnell, had been with me since day one. He asked me one Thursday if everything was okay. I told him yes. I couldn't look him in the eye when I said it. My wife, Renee, knew things were tight. But she didn't know the full number. She worked as a registered nurse, long shifts, exhausting work, and I didn't want to put more weight on her shoulders. So I kept the worst of it hidden. I handled the mail before she got home. I moved money between accounts to make the checking look less alarming. I told her we were working through a rough patch. I was lying. Every single day, I was lying. The collection calls started in October. First, it was the equipment leasing company, then the credit card company, then, and this was a moment I will never forget, I got a letter from the IRS notifying me of a tax lien related to unpaid employer payroll taxes from a quarter I'd deferred during the shutdown. IRS debt. On top of everything else. I sat in my car in the parking lot of my own restaurant and I cried. I am a 43-year-old man who coached youth soccer and smoked brisket for 11 years and built something real. And I sat in that parking lot and sobbed because I didn't know how to tell my wife, I didn't know how to tell Darnell, and I didn't know what came next. I stopped answering my phone entirely. I let voicemails pile up. 12, then 20, then 40. I would see the same 1-800 numbers calling 3 and 4 times a day, and I would just let it ring. I told myself I was buying time. I was not buying time. I was making everything worse. The worst decision I made, and I want to be honest about this because maybe you've thought about doing the same thing, was in November. A buddy of mine mentioned a debt settlement company he'd seen advertised online. The pitch was simple. Stop paying your creditors, let the accounts go delinquent, and they negotiate a reduced lump sum. They charged a monthly fee of $450 and promised to cut my debt by up to 60%. I signed up. I paid them $450 a month for 3 months, money I did not have, while my accounts continued going delinquent. My credit score, which had been around 660, dropped to 511 in 90 days. One of my creditors didn't wait for a settlement. They sued me. I got served with court papers on a Tuesday morning while I was prepping mise en place. The settlement company, when I called in a panic, told me litigation was outside the scope of their services. I had paid $1,350 to make my situation measurably worse. I also, and this is the part that still stings, I pulled $8,000 from my IRA. I was 43. That meant a 10% early withdrawal penalty plus income taxes. I effectively paid nearly $2,400 in penalties and taxes just to access $8,000 that was supposed to be retirement money. I used it to make payroll for 6 weeks. 6 weeks. The restaurant officially closed on December 14th. I handed Darnell his last check in the parking lot. He hugged me and told me I'd built something good. I couldn't speak. The week after Christmas, Renee found a stack of unopened collection letters I'd hidden in the bottom of my toolbox in the garage. She didn't yell. She sat down at the kitchen table and she said, "Marcus, tell me everything." So I did. I told her about the $81,000. I told her about the IRS lien. I told her about the debt settlement company and the lawsuit. I told her about the IRA withdrawal. I told her I had been ashamed and scared and I thought I could fix it myself, and I was wrong. She was quiet for a long time, and then she said, "Okay, then we figure it out together. But you have to stop hiding it." That conversation, that specific moment, was the turning point. The next day, I called a nonprofit credit counseling agency. They were certified through the NFCC, the National Foundation for Credit Counseling. The call was free. I did not pay anything up front. The counselor, a woman named Patricia, walked me through everything without judgment. She asked me for a full picture, all income, all debt, all monthly expenses. She told me that given the business loan, the IRS debt, and the active lawsuit, I should strongly consider meeting with a bankruptcy attorney before making any other moves. I want to explain here what I learned because I had a lot of misconceptions about bankruptcy. There are 2 types most individuals consider. Chapter 7 is a liquidation bankruptcy. In a Chapter 7, most of your unsecured debts, credit cards, medical bills, some personal loans, can be discharged, meaning legally eliminated. The process typically takes 3 to 6 months. However, you have to pass a means test based on your income and household size, and not all debts are dischargeable. The IRS payroll tax debt I had, for example, is treated differently and requires separate negotiation. Chapter 13 is a reorganization bankruptcy. Instead of liquidating, you propose a repayment plan, typically 3 to 5 years, based on your disposable income. Chapter 13 can allow you to keep assets, address tax debt over time, and stop foreclosure proceedings. The automatic stay provision in both chapters immediately halts collection calls, lawsuits, and wage garnishments the moment you file. The bankruptcy attorney I consulted, I paid $200 for the initial consultation, reviewed my specific situation, and gave me his honest assessment. Given the mix of business debt, IRS liability, and the active civil judgment from the creditor who sued me, he recommended a Chapter 7 filing for the dischargeable personal debt combined with a separate IRS installment agreement for the payroll tax portion. He also said something I needed to hear. Chapter 7 will impact your credit score and remain on your credit report for 10 years. Your FICO score will drop, but your FICO score is already in the low 500s. The question isn't whether this hurts your credit, it's whether it stops the bleeding and gives you a foundation to rebuild. Always consult a licensed professional before making any financial or legal decisions. Everyone's situation is different, and what worked in my case may not be the right answer for yours. I filed Chapter 7 in February. The automatic stay went into effect the day I filed. The collection calls stopped. The lawsuit was paused. For the first time in 8 months, my phone was quiet. The discharge came through in May, 4 months after filing. $38,700 in unsecured personal credit card debt. Discharged. I entered a structured installment agreement with the IRS for the payroll tax balance. The SBA loan, because the business assets had already been liquidated, was handled through the bankruptcy proceedings. My credit score at discharge, 524. Not great, but stable. And mine to rebuild. I want to be honest about where I am now, because this is not a story where everything gets magically fixed. I am working. I took a job as a kitchen manager at a hotel restaurant. The pay is steady, $52,000 a year. Renee and I are on a strict budget. We use a credit counseling debt management plan for the remaining debts not covered by the bankruptcy. We make one consolidated payment a month. No more hiding, no more shuffling money between accounts. My daughter asked me last month if I missed the restaurant. I told her yes, every single day. She said, "Dad, you'll have another one." I didn't correct her. Maybe. Not soon. But maybe. What I know now that I didn't know at my worst moment is this. The shame you feel when debt gets this bad is the most dangerous part of it. It's what made me hide the mail. It's what made me lie to Renee. It's what made me pay $100 to $350 to a company that made things worse. The shame will push you toward decisions that cost you more than the debt itself. If you are sitting with a number that feels impossible, whether it's $30,000 or $80,000 or more, the first step is not a perfect plan. The first step is telling somebody the real number. A credit counselor, a bankruptcy attorney, your spouse, someone. Because the math doesn't get better when you're doing it alone at 2 a.m. Get the free debt checklist in the description. The link is below.